So you want to get started investing, and now everyone's telling you that you need to invest in this stock, this fund, buy these bonds, and even throw in some gold as well. Things just got a lot more complicated. And now you found out that you have to make an investing portfolio. Sounds very fancy, doesn't it? And complicated. So in this video, I wanted to keep things really simple for you and take you through everything you need to know to get started in making your own investment portfolio. Firstly, let's just explain what this thing actually is. An investment portfolio is just a collection of things that you can invest in. It's really as simple as that. It can be as simple as investing in one single thing, or it can be complicated as investing in dozens of different things. The main thing to say is that our investment portfolio, the things that we want to have inside of it, are assets. Remember that assets are things that will grow in value over time. And for example, for most people, their biggest asset will be their house, which even once you remove the rest of their mortgage, is still their largest single most valuable thing. Assets are the opposite of a liability, which is a fancy way of saying either a debt or something that will cost us money. For example, any kind of loans for cars or debt on credit cards are all liabilities, which is really something we want to avoid, certainly where possible. There are lots of different kinds of assets we can have in our portfolio, and these things include stocks, bonds, mutual funds, property, crypto, cash, and even commodities. Assets are extremely important to help build our wealth, because if we don't grow our money faster than inflation, then we'll be losing it. At the moment, inflation is soaring really high across the world, which means it's more important than ever to have assets which grow. Over time, inflation will slowly but surely mean that any money you hold without being invested will eventually become worthless, and we definitely don't want that. I won't go into too much detail here about the different kinds of assets, but the main ones we'll focus on will be stocks and bonds. Inside of that, I'll also throw in mutual funds and index funds too. The concept of investing into assets like stocks is that when you buy a share in a company, that you are then part owner of that business, meaning that of all of the profits that they generate and all of the future cash they create, you're entitled to your share of that, even if it is only a tiny percentage. So for example, every one of Apple's shareholders, the largest company in the world, is entitled to the profits of the company and all of the other assets that they own. Just be warned that there are 16 billion shares of Apple, so you would need a lot of money to have any kind of a large stake, but hey, you get the idea. In the past, owning stocks has been one of the most effective ways to grow your wealth, and they have performed really well over long periods of time. So, for example, if you were able to go back and invest into stocks and bonds all the way back more than 2 centuries ago, here is how you would have performed. Your great-great-grandkids will probably say thanks very much. As you can see, stocks have won the race and have provided you a real rate of return of over 6%, and that means that over the long run, the value of your investment into stocks has beaten inflation by 6.6% in this case. And just in case you ever hear that term again, the real rate of return is the value you get once you remove inflation from the change in the value of your asset. So, for example, if your Apple stock goes up 10% in a year and inflation was 4%, then your real rate of return was actually 6%. Nice and simple. Bonds, on the other hand, can still help investors perform well over time, but they work a bit differently. Bonds can be offered out by governments and companies all over the world, and they're effectively just an agreement between you and the seller of the bond to provide you with an interest in exchange for giving them money. So, for example, the US government offers all kinds of bonds known as treasuries for all kinds of different lengths of time, and in return for your cash, they might give you, say, 2 or 3% in the form of interest back. And although that doesn't sound like a good amount right now, when interest rates were really high in the past and the stock market was doing really badly, bonds can sometimes perform really well, especially if they might provide the only positive return compared to everything else out there. So don't rule them out, but certainly at the moment, nothing is really giving us a real positive rate of return. Outside of these two, we've also got things like REITs, which are real estate investment trusts, which allow you to invest in property without having to go and buy anything yourself. And don't forget commodities as well, and even cryptocurrency too. Some investors feel safer holding commodities like gold and silver or other precious metals like copper, while others don't want anything to do with shiny metals and prefer a digital shiny metal. But at the end of the day, it's all up to you as an investor to figure out what you want to have in your investing portfolio. So this leads us on nicely to the next section. How do we figure out what we want to invest in and how much of our money do we want to invest in each one? Right, so we know that we want to invest in things that go up in value and beat inflation. However, we don't know which assets in our portfolio will be the best performing ones for the next year or many years after that. This means that we're going to need to diversify to ensure that we hold many different kinds of assets. Otherwise, if you bet on just one, you might end up lucky, but you could also end up doing really badly. Being diversified helps reduce our risk, and this is where you need to step in as an investor. This part really is all down to you, your own goals, and your risk tolerance too. You might want to ask yourself why you're investing in the first place. Is there a goal in mind? Maybe it's for a deposit on a house, or for your kids, or for your own retirement. Now, I don't want to make things too complicated, otherwise you'll probably never want to invest or bother getting started at all. But just consider some of the things anyway, and also think about how much risk that you want to take. Investing can be risky, and the small print says that your capital is at risk. And just because you've invested thousands, there's nothing stopping a big global market crash and your investments going down to, say, half of their value. The key question is really asking yourself, how would you feel if that happened, and can you still keep going? It might be easier said than done. And as a way to combat this, let me show you generally how you might be able to start to make a simple portfolio. Typically, you can balance a portfolio using stocks and bonds, and also to keep things really simple, we can use index funds, which are probably investors' best friends. Don't worry, when it comes to picking the right stocks and bonds, with index funds you won't have to worry about which companies to buy or which bonds are the best. Honestly, it's so much easier now than it was many years ago. To make this visual, imagine a pie chart, and the whole pie represents your investment portfolio. How you slice up that pie is completely up to you. Some people might just cut it in half and say, I want half in stocks and half in bonds. And other people might say they want 100% of their pie to be stocks and just completely ignore bonds. Or you might find that somewhere in the middle works for you. There was a general rule created by investors that said, if you take the number 100 and then minus your age, that gives you how much of your portfolio should be in stocks, leaving the rest to be bonds. So for me at 33, we'll just call that 30, meaning that by the old rule, I would have 70% in stocks, leaving 30% to bonds. However, with people living longer, it has been suggested that as a guideline, you might want to start at 110 or even 120. So if I started again and used my age rounded down to 30 and take that away from 120, I might want to have, say, 90% of my portfolio in stocks and 10% in bonds. However, take this with a pinch of salt. It's completely up to you, and it's just a concept, and it all comes down to what you want from your investments and your own level of risks. To buy our stocks and our bonds, there's loads of options out there, and we can even invest in just a single fund that mixes both bonds and stocks for us automatically, meaning that all we'll need to do is just keep investing. If this sounds like a route for you, then there are funds out there from companies like Vanguard called the Life Strategy range, which comes in different options specifically designed to meet the mix of stocks and bonds that you might want to have. For example, the Life Strategy 80% equity fund will have 80% worth in stocks and 20% in bonds, and it will keep that balanced for you over time. There are loads of these available, but hopefully you get the idea there. If you want to put something together yourself instead, then you'll probably want to look at some kind of global or broad market index fund. And when I say that, I mean some kind of fund which has as much of the global stock market in as possible, or at least enough that keeps you well diversified and happy. And speaking of well diversified and happy, if you are finding the video useful, please do me the pleasure of investing in that like button by giving it a quick click and subscribing too. It really helps get this video in front of more amazing people like you. And now with that done, let's keep going. Again, as an example, you'll find many index funds sold as either mutual funds or ETFs that track the entire global market, or just major markets like the whole of the developed world and even just the US. I've made videos on this topic recently looking at a portfolio just like this, so don't forget to check that one out after this video. If you want to put one together yourself, then it's really up to you. You could have your global index fund and combine that with a global bond fund, work out how much you want to invest, and then go ahead, nice and simple. A bond fund is similar to an index fund for stocks, meaning that rather than trying to pick which bond to buy, you can just buy a huge collection of them, which saves you all of the hassle and time it would have taken to go through them, and then reduces your risks massively. Now, personally for me, I don't invest in bonds, and I've got no plans to, and as a 33-year-old, my time horizons are long. I'm investing for retirement, and I've got a pretty strong risk tolerance, so I'm very happy being all in on the stock market, mostly in index funds, but I do also have my own selection of stocks and crypto too to add into my portfolio. Remember that I'm not a financial advisor, this is all of my own personal choice, and your portfolio is completely up to you to make, and it can be as simple or as complex as you like. Let me just bring in a few more examples that we can talk through. From the most simple portfolio, you can quite happily invest in one of these mixed asset funds that do it all for you, so your pie is really simple and it's just one investment for you to manage. Then, as we progress to slightly more DIY based ones, you might want to look like something like this, which is maybe 90% in a global index fund and 10% in a global bond fund. Taking it a few steps further, if I look at my own investments, I'm probably something like 50% index funds, 30% individual stocks, 10% cryptocurrency, and then 10% of private investments. In your pie, you can add property, commodities, whatever you like. Remember though that if you do keep things nice and simple with a global index fund, you will get exposure to lots of other assets indirectly. For example, in the S&P 500 in the US, there are dozens of REITs inside that index already, so I'd probably say that you don't really need to invest in additional REITs from outside of it unless you really want to double up on your property investment. And also this goes the same with commodities. In my opinion, you'll already have companies that trade in oil and gas and other major commodities inside of an index fund, so personally for me, I wouldn't see the need to add any extra, but that question really is all up to you. Before we go to the next section, there isn't a best mix or best investment portfolio you can invest in, and it can look as simple or as complex as you like. It all depends on your own personal goals, your own level of risk, and how you feel. If we all knew the future and we knew what asset was going to rise in value the most, then of course we'd all just invest in that one thing. But unfortunately, we have no idea, so we just got to try and be sensible and make some educated guesses. Okay, a quick talk on how much you should invest in your new shiny investment portfolio. This one, I'm afraid, is going to be personal to you. So the answer really isn't going to be a number. The answer is just as much as you can, if you can, and as often as you can. We can't get around the fact that in order to invest, we first have to spend less than we make. And I know that sounds really simple and obvious, but many people can't get over that first hurdle, so they don't make it to be able to even invest in any assets at all. To give you some inspiration though, here are two examples that show you what happens if you're able to make some decent returns on your investments over say 20 years. It doesn't matter what currency you use here, but I'll just say pounds to keep things simple. But the same concept works with anything. If we say we're able to invest $100 a month for 20 years and we manage to get a real rate of return of 8%, we end up with almost £60,000 from a total investment of £24,000. That's pretty good and nearly 3 times our total investment. Now, just for fun, if you can increase the amount you invest to say £500 a month, let's see how much difference this can actually make. That takes us to nearly £300,000. And now let's take things one step further. Almost any person who started investing always wishes they had started earlier, and I include myself on that one. I'll let you know once I meet someone who says they wish they'd never started. Anyway, what if we increase our time by a few years, let's say 25 years? Keeping the 500 just for fun, we end up with £479,000. So in just an additional 25% worth of time, we can make more than 50% in our gains. And that is the power of compound interest, ladies and gentlemen, and investing. So just before you rush out to invest, let's talk about where you can actually do it safely, because there's loads of platforms out there to choose from. In short, without going into too much detail, make sure you use the right account type for you. So for us in the UK, take advantage of your stocks and shares ISA where you can. This is a kind of investing account that allows you to grow your investing completely tax-free. By using accounts like this, you can build up your investments over a really long time, and at the moment you want to start taking money out and start enjoying yourself, you won't owe the taxman anything, so all of your lovely gains are all yours compared to if you were just using, say, a regular account. Now, not every platform does provide you with the ability to use a stocks and shares ISA, and you can only contribute to one account per year. And over the years, you can have multiple accounts set up, that's no problem, but just try and be careful and strategic about what you want to do. More accounts just means more to keep an eye on, but it's all up to you. If you do want some recommendations on platforms I use, see my links in the description below, and you can also get some free cash or free shares with some of them, and it also helps support my channel. I've also done many different videos looking at different platforms, and I share all of those ones that I use on my channel as well. Another thing to look out for is making sure that any platform you use is FCA regulated and protected by the Financial Services Compensation Scheme here in the UK. If you're watching from anywhere else, then look to see what your regulatory body's called and what assurances you can get. The last thing you want is for all of your hard-earned money not to be protected and not to be safe in the event that your investing platform goes bust, because it absolutely could happen and it won't be fun if they aren't regulated. I really hope you've enjoyed the video and found it useful. To keep learning and to get more information, feel free to watch my complete investing for beginners guide here, which will tell you all about all the other things you need to know just before you get started. Thanks for watching, and as always, happy investing.